The S&P 500 is considered the most reliable asset to just buy, hold, and forget. It consists of the top 500 companies inside the USA, all bundled up into one stock, which is known as an index fund. The logic of index funds is that rather than putting all of your hopes and dreams into one company, you're buying all of them at once. In this case, 500 of them at once. In general, if the American economy is growing, then the S&P 500 is growing too. A defensive investor's approach is to just buy and hold the S&P forever, and you can expect to make about 10% per year on average. However, there's a very specific approach to doing that right, which we'll get into later in the video series. This is what investors are referring to when they say the market. For example, when you hear people say beating the market or phrases like that, this is the market. The S&P 500 is the benchmark for the market, which our job as investors and traders is to beat. To generate alpha is referring to beating the market, and alpha refers to an amount in excess of the S&P 500. So, for example, if one year the S&P 500 makes 10% and you as an investor make 40%, you've generated 30% of alpha because you've beat the market by that much. The logic of that, if you didn't already get it, is because if you're not beating the market, well, why don't you just buy and hold the S&P 500? It'll save you a lot less time and a lot less hassle. Gold is considered a safe haven investment. If you didn't already know, it's a limited commodity which we value as being useful and worth having. Gold was money before money was even invented, and gold used to literally be directly correlated with the value of the dollar before the forex market was invented in 1972, but we'll talk about that again in a later video. Now, because there's a limited amount of it available, and as time goes on, less of it becomes available, naturally its value increases over time, which is the fundamental basics of supply and demand. Now, when the economy is good, people are generally investing in other things, like stocks or real estate or businesses, or just spending their disposable income on luxuries rather than necessities. However, when the economy is unstable or uncertain, people spend less on luxuries and people spend less on investments like stocks, shares, real estate, etc. And they start to pour money in more defensive and more safe haven investments like gold. Now, if you just buy and hold gold forever, similar to the S&P 500, you'd make about an average of 10% per year. But there's a very specific way to do this in order to do it right. And now, when I say 10% per year on average, here's some examples of what on average looks like. During the calendar year of 1979, the value of gold increased by about 180% in one single year. Whereas in 2013, the same asset, gold, fell about 30%. So if you would have bought at the start of 1979 and held all year, you would have made 180% return on investment. But the same asset in 2013 would have fell by 30%. If you bought gold in January 2013 and held it all year, you would have lost 30% on your investment. Now, in this video series, I'm going to teach you all about wins and losses, winning streaks and losing streaks, peaks and troughs, time in versus timing, and I'm going to use gold and S&P 500 as clear examples, as these two are regarded as the most reliable, the most safe investments over time, as you can see by the long-term exponential equity curve. But still yet, with these readily available, 4 in 5 people lose money when they approach the financial markets. And the reason for that is because even though gold and the S&P 500 are considered the all reliable and safe, they're still bound to the fundamental laws of the financial markets. And in order to navigate that, you need a winning mindset for trading and investing.